Today, I'm going to be talking to you about one of the companies that I have had the most requests to cover on this channel. It is a Canadian oil and gas star, a great opportunity that so many investors are incredibly bullish on. We have seen highly praised analysts claim this thing has 50% plus upside over the next 12 months. And we've seen some really awesome strategic moves that have made this less risky than a lot of other Canadian natural gas plays, but give them the opportunity to benefit from all of the potential growth in the Canadian energy industry and protect your downside risk. Today, we're going to be talking about ARX Resources. It's one of those companies that so many investors are so bullish on that it just needs to be talked about. We need to take a deep dive into this stock, see what is it that they're so excited by? What's the story here? What can we build an investment thesis on? And will this fit into our own portfolios? Welcome to Golden Arch Investing. My name is Liam. On this channel, we talk about investing in Canada. If that interests you at all, please do like the video, subscribe to the channel. It makes a massive difference. Now, like I said, this is one of the companies that many people have recommended I talk about. I would say the most, but maybe not quite, right? There's a couple names in there, and is one of these slightly smaller Canadian oil and gas names that has this huge potential thanks in large part to its valuation. The first time I actually started scripting this, I was going to talk almost uniquely about the undervaluation, because on a forward PE basis, this stock looks ridiculous. But beyond that, I think the real story here is about asymmetric upside. And by that, I mean the potential for huge upside with your downside risk limited by factors within the company. And it comes from the core pillars of what make this company so profitable. What exactly is it they do, and how are they going to benefit from near and long-term trends? Of course, I think the real trend, if you're just here for the main pitch, the real trend for these guys is Canadian natural gas prices are increasing dramatically. LNG Canada will benefit the entire industry, and there are a whole pipeline of projects all the way through to 2030 that will continue to increase Canadian LNG demand, setting a base price underneath LNG here in Canada, underneath natural gas in Canada more generally, and will help them gain closer to parity with the US market. To give you a frame of reference, if you've never talked about this market before, right now, Canadian producers are about $2 less per million cubic feet than their American counterparts. Which means right now, if we say they're at 2 and their American counterparts at 4, well, if you see Canadian producers suddenly get $3, well, all of a sudden the story is completely changed. The profitability of these companies goes through the roof. And of course, if you're trading at a PE of 8 and suddenly your earnings, we can't say double here, but your earnings rocket upwards. They're up, 20, 30, 40, 60, whatever percentage wise we see. Then obviously, if your PE ratio stays the same, your company is going to be up 30, 40, 50, 60%. But the real story, I think, is that people are going to become more interested in these companies as they see this potential roll in. Other businesses are going to be more interested in these assets as they see that money start to flow. And if we see these projects continue to accelerate, like a phase 2 of LNG Canada or some sort of Eastern Coast, right? Maybe like literally an East Coast pipeline and a East Coast LNG terminal, a Hudson's Bay terminal at the sort of Port of Churchill that we've seen in the news. Any of these major possible news stories, we could see, PEs of 10, 12, 16, that would then represent, again, a huge jump in stock price, right? That we're seeing up to a doubling in that case, where investors start to get excited and the market itself starts to drive the price upwards. That's the huge upside potential, because the profitability looks like it's going through the roof. But where does the downside protection come from? Well, that's a really interesting story. And because I can't really cover it in detail with just absolutely no visuals, no explanation, I'm going to refer right here to a Seeking Alpha article that I read. It's from a guy named Andrew Mack. I'm going to put it on the screen for you guys. I think it is a really interesting read. I strongly recommend you read it if you have Seeking Alpha Premium. Of course, I will cover all the details here, but he does a good job breaking it down and sort of showing it to the viewer. What is it that protects the downside, and why is it that we're going to see free cash flow yield going up over the sort of short term? I was going to say near term, but right, sort of short term in the sort of next 12, 18 months. And why that's a really interesting story, right? When you can see free cash flow yields in the teens versus where they're sitting today. So if you just want to see a summary, he talks about the Atashi phase run. He talks about structural undersupply and premium pricing over WTI and how that impacts the condensate, which is our most profitable pardon me, ARC continues to outperform AECO produced pricing by 65%. So again, with AECO pricing going up, if ARC's outperforming, that's really awesome. 2029, over 25% of ARC's gas will be sold at international LNG benchmarks, boosting free cash flow yield again up into the teens, which is huge. And at $25 a share, ARC returns 100% of free cash flow via dividends and buybacks and remains priced for a 15% annual compound return with a fair value estimate of $32. So right there and then, you see why investors are excited. If you're an investor in this kind of space, where you're looking at, shareholder returns, you're looking at free cash flow yields, you're looking at these companies literally printing money, those numbers look really good. But we need to dive into the business itself, because usually when something is, let's say, undervalued, there's a story there. The market isn't that inefficient. It's not like nobody's heard of this company and so they're not touching it. There are things that have been going on that have been adjusted over time. There are risks here that the company is really dependent on certain resources that obviously make it a little bit more reasonable. But of course, I'll show you through the article here. So I should mention this article is written in February of 2025, before a lot of the sort of tariff panic, recession panic that we seem to have made a V-shaped recovery out of. So whether or not we see all that sort of panic that was this spring actually impact ARC's year and change what this analyst expects, I can't tell, right? I don't have a crystal ball. I can't see the future here, but it is important to mention a lot of the things he says are going to be true as of February 2025. He talks about the huge returns 2024, really a transformational year. They finished that Hitachi product. They spent a lot of money on it, which is always sort of a risk, right? In any industry, if you're investing huge amounts of money into any project that's supposed to expand your business or diversify your business or, add a new business segment, it's a risk. And oil and gas is no different at all. These guys are spending huge amounts of money. There are all sorts of variables. They have hugely talented teams of people doing it, sure. But investors always put that risk premium whenever a company is doing one of these big projects, particularly when they're a smaller company, right? An Enbridge doing a huge project, I feel like more investors are going to forgive them, maybe not add that risk premium, versus an ARC. Well, all of a sudden, a lot more investors are a little bit nervous about what's going to happen with this project. How's it going to work out? Are the projections going to come true? So because Hitachi is only really coming online this year, we don't see so much, but there are definitely some, positive signs so far from Q1. He talks about free cash flow yield. He talks about this, really interesting, 2024 free cash flow yield of 4%. With Hitachi in full ramp up, with the full impact hit this year, they expect analyst expects free cash flow to triple in 2025, 1.8 billion, which is nearly a 12% yield. And of course, he mentions 3 pillars, which is why I think it's a really interesting article. The main thing, right? Condensates, future LNG exposure, and premium natural gas sales, and how they are the clear path for growth, and why I think the sort of 3-pillar approach here helps us understand why there is a protection to the downside. So let's talk here about pillar 1, condensates. Now I could be saying that word wrong. Forgive me if I am, because I've read about it a lot, but it's one of those things that if you don't work in the industry, you maybe don't say it very often. They're ARC's #1 sales driver. They're over 6% of sales, despite making only 25% of production. They are structurally undersupplied in Canada, meaning there is less of them than the demand. And there's a high demand from oil sands producers like Canadian Natural, Suncor, Cenovus, MEG, and Imperial, which rely on these condensates to blend with their bitumen for pipeline transport. Structural undersupply makes Canadian condensates trade at a premium to WTI, giving ARC superior margins that protect the company in lower commodity price environments. Right there. This guy's talking in February 2025. Think about what the market looked like. Think about what the WTI price was still near 80, if not in the 80s on the date. It was February 10th. So, I would have to sort of go back, but we're talking WTI price near 80, which is a $20 premium to where we're trading today, right? He did not know that the price was going to fall off a cliff. But as I'll show you guys later, thanks to this business, ARC was able to weather the WTI hit like nothing happened. Like a lot of the natural gas players, they kind of just shrugged off the oil crisis, the worries about OPEC, all this that had really hit a lot of Canada's oil sands companies, and just kept trucking along. And think about what the demand is from, right? Think about the baseline there. They're not dependent on global oil demand, because a lot of these producers are not going to change their strategy in the oil sands. They're not going to suddenly start cutting production in the oil sands when they spent all the money up front for that production to happen. They need this stuff, and it's stable because they're selling it to an industrial base. And so while this business might be, a little bit of a risk thanks to its size, right? Being so much of ARC's overall business, it's hugely stable and of course hugely profitable. Honestly, it's an awesome business, right? And he talks about Hitachi phase 1, right? How it has a high yield of condensates to liquids and how the condensates are huge, right? So you look at the production here. It talks about production over the year, right? As it ramps and ramps and ramps, right? They're not booking the reserves for future Hitachi phases. The focus has already shifted to phase 2, scheduled for 2028, which will add another 40,000 barrels of oil equivalent a day. So this business is like the bedrock. This is your shield here. This is what protects you from a lot of the risks that could cut other oil companies, particularly smaller ones that maybe investors assign more risk premium. This is the thing that keeps this stock from dropping quite as much, because obviously the stable demand for these condensates are going to keep them in a better position. And pillar 2 is, of course, one of the big things that we've talked about just now, natural gas, and how that is going to be awesome in the near and medium term, right? The next 12 to 18 months looks strong. LNG Canada comes online. We finally see that AECO price sort of jump. We finally see the real process as suddenly there's this baseline demand, right? So in the summer, when LNG price when natural gas, I got to stop doing that. When natural gas price drops off, usually because people aren't using it to heat their homes, well, all of a sudden there's still this LNG, right? We still have this baseline demand. We've seen what happened down in the United States when the LNG business came online. All of a sudden, this natural gas that seemed like an unprofitable business was being used to great benefit from a lot of these oil majors, from a lot of these shale oil companies. And of course, same story up here. Natural gas is huge, right? Natural gas prices are volatile. ARC outperforms a lot of other Canadian producers. They get premium pricing. So ARC realized 2.37 per million cubic feet, 65% higher compared to AECO pricing, right? This marks the 12th straight year our market diversification strategy has resulted in realized gas prices that exceed AECO by 20% or greater. Now, past performance does not guarantee future performance. That is, of course, one of the important drivers here, right? This might not remain true in the future because maybe companies that only supply LNG, the ones that have sort of got those contracts in the door right away with LNG Canada, maybe they outperform for the near term, right? Because their overall average realized price might be better. But I still think ARC has clearly demonstrated they are really, really good at this, and we should expect good results over the sort of longer term, right? And there's just so much. Their prices are fantastic. I think maybe we should not be quite super hyperbolic about this, but they're claiming here that 50% of the Montney gas supply costs below zero. Obviously, that's sort of dramatic. It's not literally free, but because of all sorts of other market dynamics, it's basically the cost basis is below zero because they've already spent all the money. They don't have to spend anything more to continue to produce this. So super interesting. Obviously, pillar 3, LNG. We talked about this. ARC's gas prices are superior. LNG, we're talking about a different league. Current differential between US and European gas is $12 per million cubic feet. And obviously, 6 million cubic feet of barrel of oil, we get a European price of $94 or $134 per BOE. Henry Hub's $20 BOE, not even mentioning AECO, which of course we've talked about being at a significant discount to Henry Hub, which is that major American one. They've got 4 international contracts in place, providing a huge potential boost to free cash flow, as well as providing pricing diversification. There's no news about LNG from ARC, but they updated the marketing presentation reflecting LNG contracts. So we've already seen this international floating. That's what they're talking about there. That yellow bar, we see that growing, 27, 28, 29. Specifically, they're teaming up with Pembina for the Cedar LNG project. And of course, not just Pembina in that project, I should say. But we've talked about Pembina on the channel. But they're teaming up with Cedar LNG. That comes online in the not so distant future, right? And we can see, 30% of the company selling at premium LNG prices. That could be fantastic. Of course, problem there, when you're projecting into the future with prices like that, we're far from the only producer of LNG. There are all sorts of world events that could change that story. So that upside is never guaranteed. But with the protection to the downside, that upside is definitely enticing. Future projections, he lowers his estimated oil prices to follow the futures of $70 WTI. Yikes, right? He doesn't know. He can't see the future. He doesn't understand that all of this crazy tariff stuff happened and prices dropped, and then OPEC did its thing, and now it's a 1-2 punch on the price of oil. But of course, that's dropping. However, his natural gas guesstimates here are not bad, right? So about $4 Henry Hub, sure, right? Prices staying higher, but ARC will start benefiting from LNG in 2028. Back to balance, I find it, back into balance, which, as I explained, I find at around $12 per million cubic feet. So huge. He shows us a lot of really interesting details here. A lot of this is a little bit sort of deep for our level of interest, right? Trying to build an investment thesis. This is the kind of research that you should be doing if you're actually making an investment decision. But the highlights here, look at free cash flow. That's sort of right in the middle of the screen there. Free cash flow. And you just see the numbers just flying upwards over the years, right? Up to 2593 at the end of the chart there. Fantastic. Okay. So with all of that being said, we understand there is this condensates business that is sort of the pillar of defense. There is this natural gas business, which of course is highly volatile, but can be highly profitable, that they have a lot of supply that is incredibly cheap for them. And there's this like LNG, I don't want to call it wild card, but maybe you can call it ace up their sleeve, right? Where they have this future LNG coming online in the next couple of years. They're expecting to have some fantastic pricing for that. And obviously that pricing could increase their average natural gas profitability. You're going to see free cash flow yields boost upwards. Now let's talk about valuation. And to do that, I'm going to jump over to FinChat. Okay, so here I have the FinChat home screen for you guys for ARC Resources. We've got a lot of numbers here. A couple of important numbers. Market cap, 16 billion Canadian dollars. That puts it at firmly the, I would call this a large cap company, but in the Canadian oil and gas space, this is definitely a step below some of the majors. We are not talking in the same ballpark as CNQ. We're not talking the same world as Imperial Oil or Suncor, but we are a little bit higher than some of those smaller companies, right? This is going to be closer to what comes out of Whitecap, the acquisition there with Varen, right? That's closer to those kind of mid-cap companies that are definitely investable. That importantly, this is not a $5 billion company. We're talking 16 billion, definitely investable. I think it will have some serious interest from potential foreign money. We've talked about the conversation about American money flowing into Canada. Talked about that in the oil space. Obviously, American money is no stranger to natural gas, no stranger to LNG. They've built the world's preeminent LNG industry down there on the coast in the United States. They know this business. So I would expect to see American money flow into this as well. But $16 billion market cap looks pretty nice. PE ratio trailing 12 months, 12. We of course know that they sort of in the analyst stuff we just talked about. We talked about the free cash flow yield, talked about exactly how much they're free cash flowing. Obviously, earnings number and free cash flow numbers are not exactly the same. You drop down just a little bit on the screen there. See price to free cash flow is at 17.2. So the earnings number looks a little bit better than the free cash flow. But both of these numbers are important because if we jump down to the next 12 months, analyst expectations. Look at the PE ratio right there, 8.5. Fantastic. Single digit PE ratio on a company with a kind of upside potential. Remember, we were talking about major investors who mentioned 50% potential upside in 12 months. Coming from the idea that they're going to massively boost their free cash flows, right? If you're looking at the sort of valuation models that try to put free cash flow and companies in sort of a respective distance, right? If free cash flow is here, the company should be priced here. Obviously, if we see free cash flow going up massively, to see the company maintain the same valuation, we need to see some more price appreciation. On top of that, we see that right now, the company is being priced at 27 Canadian dollars and the price target is at 32, right? So whatever analyst they're using on here or whatever sort of consensus estimate they're using on here is only expecting about $5 of price appreciation. And so if you were to see that PE keep up, right? If you were going to see that PE stay at 12, you'd need to see another $5, $10, right? Which on a $27 stock is a significant amount of money. But even better number, I want you to look down, right? We talked about price free cash flow there was 17, significantly higher than the price to earnings. If you drop down on that list, I'm sure you can see it right now. Price to free cash flow expectation next 12 months, 7.7. So we are going to see the free cash flows that are currently lower than the earnings push through that earnings number. The free cash flow is going to look even better. And I sincerely think this means that they are underestimating the valuation that's going to be put on this company. Just think for a second about what could the market for these guys look like in 12 months. Just, for the sake of hypothesis here, think about a world where we actually see the government approve serious conventional, as they call it, energy projects. Think about a world where there actually is approvals or some sort of, push for business and government to work together on an LNG terminal at Churchill, or expanded LNG terminals on the West Coast, or an LNG pipeline across the Eastern Canada to supply the demands of Eastern Canada instead of piping it in from other markets. Just imagine the kind of price. On top of that, remember that 60% of their business last year was supplying oil sands producers. Now, where do you think that business is going to go if all of a sudden we see crude oil pipelines, crude oil terminals? Am I saying that's as likely as the LNG stuff? No. We have clearly seen LNG has been easier to build over the last 5 years. It is a new government, sure, but LNG seems to be the easier, safer bet. I think there's a real story here, though, with the sort of environment they're in. What are investors going to be thinking about? On top of that, investors are probably going to be more risk on over the next 12 months than they have in the last couple. Now, last December, let's say, investors were taking on every risk they could find. Companies that were taking high risks with high growth were being rewarded massively. Over the last few months, as everybody's gotten scared of tariffs, everybody's gotten scared of recession, as OPEC has clobbered the market, anybody with risk in the sort of valuation saw their stock price drop. We saw this happen with, big names like Palantir that are these investor favorites. We saw a lot of retail investor darlings get cut down. We saw big tech get their valuations cut. Everybody took a sort of, took a cut. Everybody lost a little bit. But as we've seen the recovery, as we've seen trade deals made, the market is just as hungry for risk. I would expect that trend to continue for the next couple of months. So now, if investors are more willing to take risks, if these guys have this huge potential upside, if we are seeing free cash flows explode to the upwards, I don't think we're going to see these guys stay at this low PE ratio. And to be honest with you, neither do a lot of analysts. So here on the screen, again from FinChat, this is their estimates tab, and I'm looking at price targets. So what they've done is they've taken a bunch of analyst price targets and they're just visualizing them for us right here. And I want you to look at where the lines go. Now, these are just dotted straight lines. It's not actually predicting the exact dollar amount. But the high target is going to end up somewhere in the high 30s. The mid is going to be in that mid 30s, probably not far off what we saw them predicting there at $32. And the low target is expected to be more or less flat. And remember, these same analysts expect this stock to trade at an 8 or an 8.5 PE. At a 7.7 price to free cash flow, which again, I do not believe will happen if we do see the positive momentum in the natural gas market that so many have predicted. I want you to just imagine for a second, just all the potential upside, the protection to the downside. Does this sound like something you want to own? Does this sound like something that you'd be willing to own in your portfolio? Because a lot of investors seem to be willing. Again, I've mentioned some big investor names like Eric Nuttall, but I think for sure this makes a lot of sense if you're the kind of investor who's willing to take a swing on a 12, 18 month story, right? You build a thesis, they have potential, you see undervaluation, and you're buying based on that. I think there's huge potential there. If you're that kind of investor, this name looks great for you. Seriously. Now, I am a longer term investor. So when I look at a stock like this, I think, okay, but what's the 5-year story? If we do see the price grow, right? We see, maybe the P is at 12, 13, 14, 15, right? A little bit more optimistic. And therefore, if we're seeing a tripling in free cash flow, then you're going to see the stock in the 40s or the 50s. So like double up territory, right? 100+% for the shorter term traders. Would I be willing to keep holding it at that elevated price for the next 5 years? Because what does the 5 years after that look like? Now, it could look like LNG Canada phase 2. It could look like Canadian LNG becoming this master, right? We're getting the huge price appreciation that everybody is predicting. We're getting all this just continuing to grow. asymmetric upside, massive growth, exponential returns. That's a potential, right? Maybe we see fantastic shareholder returns from these guys, share buybacks, again, pumping that price to earnings ratio, making it look even better. Or maybe we don't see that story play out long term. Maybe we don't see the 5+ year mega trend of Canadian energy just grow. What does the story look like then? And I think that's the interesting thing that I've asked myself as an investor. I honestly would be much more willing to hold this as a play on the next 18 months. I think that's where I would be looking for. If that's something that interests you, go for it, right? Do your research. Please do your research. Look into this company, decide that it fits your portfolio, but go for it, because from everything that I can see, from the information I have available, looks like it has a huge potential. But if you're a long-term investor, if you're holding 5-10 years, there might be better options in companies that are a little bit slower, a little bit more of an established brand, right? A company that can make it through another downturn if things don't play out as well. Not that you guys can't. Again, huge downside protection from the Condensers business. I just think it's definitely a little bit more of a play on the next 12-18 months. That's my thoughts. Let me know what you think down below. If you're one of the people that requested this company, let me know. Do you agree? Do you still own the company? Did you sell out during the tariff panic? Are there other names that you prefer? Who do you like in this space? And do you agree with my sort of evaluation of them as a really interesting, 12-18 months, maybe not a swing trade, a little bit longer than that, but a play on the growth, the LNG Canada boom, on that big rush of money and the potential, just potential, for more Canadian investment into the space. Let me know what you think in the comments down below. And as always, if you enjoyed this video, please do like the video, subscribe to the channel. Makes a massive difference. Doesn't cost anything. And with all of that being said, I hope I see you in the next one.